I am so incredibly excited. I have a stock that went down 12% in a single day. That was today. It went down 12%. And this same stock has gone down 44% since its peak. So it's on a downward trend. And I could not be more excited about this. And this might sound a little weird, but the reason I am excited is because I invest for dividends and cash flow. The price per share does not really matter to me. In fact, I like it when the share price goes down as long as the fundamentals of the company are good, as long as it continues to pay its dividend, because I can secure higher starting yields. Meaning the lower the share price, as long as the dividend stays constant or grows, the percentage yield, the dividend divided by the share price, it actually goes up. So I get more cash flow, more passive income. And I am talking here about Campbell's Soup Company. This is a stock I've owned for a while. I want to talk about this stock today. I want to talk about this in real time because this is something that came up just in the stock market today. What I think about this 12% drop, how I'm looking at this situation, and how history just tends to repeat itself. It seems like this is always the case in the stock market when these types of sales occur, that I just love to jump on those opportunities. So let's get started. So welcome to the video today, everyone. If you've been following my channel, you know that I've been doing a multi-part series here on the oil sector. I want to take a pause from that, however, to discuss some real-time news, and that is with Campbell's Soup Company, a stock that I own in my portfolio. And this is a stock actually that's a smaller position. It's a minor position. It will never be a big position. I'll talk about that why later, but I still like it. It's important to my portfolio. It plays an important role in the portfolio. And I was excited to see it tank like it did today. And I actually went out and initiated a purchase order. So I'm really excited to buy more shares of Campbell Soup at these prices. And so I look at it as a gift, as a buying opportunity. But I'm excited actually that this comes in the middle of this oil series, because just a few years ago, everyone thought that these oil companies had no future, that they were going to go out of business, that the price of oil was going to be low forever. And I will link in my description below to my latest oil video about my position in BP. And on some of the purchase lots that I purchased on BP just a few years ago, I am yielding 8+% on cost. And I am proud of that because I put a foot forward. I put a foot forward to buy that stock. I took that risk when everyone else was saying, hey, that industry is going under. And it seems like history is repeating itself here, although this time it's in the consumer stocks. If one looks at the stock market in 2018, consumer stocks, everyone just hates them. Everyone hates them. And I love this because consumer stocks are my favorite stocks. Consumer non-cyclical stocks like Campbell Soup. I love these companies. Why do I love them? They produce the foods, the household goods, the brands that all of us need to live. They're not going anywhere. But the reason that these companies are down are actually a few factors. One, interest rates are on the rise. And with interest rates on the rise, dividend stocks in general are less attractive to certain investors who now have options. Maybe they want to buy bonds instead of stocks to drive income, whereas a few years ago with interest rates at all-time lows, really dividend stocks were the only option for income-minded investors. So those investors now have more choices. The other reason that these types of stocks are down is sluggish growth. The revenue growth, the earnings growth, it has been a bit sluggish at these companies. That being said, I think that everyone who's saying they're sluggish growth, they're facing challenges, the millennials have different buying habits, Amazon is taking over, a lot of this is short-sighted. People are looking at data just from the last few years, maybe even the last 5 years, but if one looks at the longer term, the bigger picture, even with slower revenue growth, at current valuations, at current starting yields, I think that a lot of these stocks, in my humble personal opinion, are great bargains for those with a long-term time horizon like myself who want to live off of dividends, who want to have these reliable, stable companies. And don't get me wrong, I think there may be continued downside in Campbell's Soup. I think it may even be going lower here, and I will welcome that. I will be excited about that. That being said, I'm starting to buy now. Certainly it's not going to be a core focus of mine in 2018. It's a smaller position, an ancillary position, but I just could not pass up this type of opportunity. So let's jump into it. I jotted down a lot of stuff for today's video. And I want to just start with some history. I accumulated this stock in 2012 and 2013. That's where I built up my position. And in general, I was buying around the $35 per share price. And it went up. It went up to about $61.75 in December of 2015. So it went up pretty aggressively, pretty quickly after I bought it. And because of that, I stopped buying it. I just didn't want to buy more. The yield was too low. The share price had appreciated too much. It just wasn't a value anymore, and I stopped buying. Well, fast forward to today, in May 18th of 2018, the stock has fallen 44% from its peak, and it's at that 35 range again. In fact, right now it's in the $34 territory, 34, 37, and so I love that. I just love it. It's back where I was buying it a few years ago, and I feel comfortable at that price just like I did a few years ago. And in fact, I think it's a bargain because this company has made some progress since then. This company has done some things since then that I think really set it up for success, especially its recent acquisition of Snyder's Lance. This is the snack food company that makes brands such as those Snyder's pretzels and even kettle chips. And so I think this company is really setting itself up for success, but I think people are getting really caught up in the short run. And so let's go down here and just look at some numbers. I jotted down a few numbers, and I looked at revenue, operating profit, operating margins. I look at earnings per share, dividends, and the payout ratio. And I look at it from 2018 with an estimate. I did not fill in all of the 2018 data just because I don't have the estimates on all of these line items. And then I did 2017, 16, 15, 14, 13, and I jotted in 2006 as well. This is important. When people look at Campbell Soup, in general, they're looking at the last few years. Most people might not even be looking back to 2013, and I'm talking about the analysts. I'm talking about the analysts out there that are saying, boy, I read so many headlines today, just hateful headlines about this company. The analysts think this company is horrible. It's going out of business. It has no future. It's just thing after thing that is going wrong. In fact, I couldn't believe it. The CEO was basically had to step down after the earnings report today. Step down from her job because of these short-sighted focus these days of everyone in this market, and it's just madness in my opinion. But anyways, the reason I include 2006 is that's the real benchmark. Let's see how this thing is doing versus 2006, because if I buy this, I don't care what it's doing 5 years from now. I care what it's doing 30 years from now, 50 years from now. And so I just want to remind myself and everyone out there that all of the talking heads, all of the analysts, all of the people speculating about the stock market, they are just looking at the short term. They are looking at the short term, and in my opinion, it makes no sense to do that. Anyways, revenue, it's basically flat, slightly down since 2013. No surprise there, very characteristic of this category. That being said, I've said this time and time again on my channel, at some point the revenue will grow for these types of companies. It just takes time, and all of these companies in consumer non-cyclical space right now, they're in a mode of transition. And some of them are turning the corner quicker than others. This is one maybe that's lagging a bit. And I'm eyes wide open with any investment. I realize that. It's no surprise. That being said, if I look back to 2006, their revenue was $6.89 billion. Well, 2017, it's $7.89 billion. And so that is some good growth, in my opinion, when one looks at the bigger picture and not just the last few years. So I think that's really important. Operating profit is actually generally up. They had a really good year in 2013. Other than that, 2017 was the best year in operating profit in recent history. And certainly the operating profit at $1.4 billion is up quite a bit from $1 billion in 2006. And so again, it's doing fine. They're growing the operating profit. Operating profit is good. And the operating margins, in fact, 2017 was a 17.7%, which was the best operating margin. This is the margin that is pre-tax, pre-interest expense. Best operating margin that they've had out of all of these years except 2013. And so operating margins are fine. They're strong. Here's what happened actually. The reason the stock was down so much today is earnings per share. They said they're facing some troubles. They're facing some troubles in 2018, and they're facing those troubles obviously on stagnating revenue growth, but more than that on margins and on the cost of materials, inflationary concerns. They're going up. There are inflationary concerns right now. And what they said is, hey, instead of what we were expecting for earnings per share, I forget what it was upwards of $3, we're going to come in somewhere between $2.85 and $2.90. Well, the fact of the matter is just last year they hit $2.89, and $2.89 was actually the best earnings per share they've had out of any of these years. And they had a $2.74 in 2014, but other than that, it's been lower. And in fact, in 2006, it was $1.84. So they went from $1.84 in 2006 to $2.89 in 2017. I would say that is pretty fantastic earnings growth. Now, what's interesting is they said, look, basically we're going to match last year. They're going to come in somewhere between $2.85 and $2.90 in 2018. So 2018 earnings per share is more or less going to match 2017, might be down a little bit. And reminding everyone, 2017 was the best earnings per share they've had. It's the best that they've had in these years, at least, that I looked at. Why is that such bad news? Why is that such bad news? I believe that the analysts, the investors, the institutions, the mutual funds, they are so hungry for growth, for short-term growth, for tech company style growth. Growth that oftentimes comes with very little or no margins, or negative margins in the case of some tech companies. And they're so hungry for that growth that I believe a lot of people are just being very short-sighted here that, look, this company has been growing its earnings per share. They have a great profit, a great earnings per share. And yes, it's not going to grow quickly. And in fact, 2018 is going to be a non-growth year. It's going to be flat year over year. But looking at the big picture, the earnings per share is growing just fine. And so it's a reminder to myself, to everyone out there, that there is a different way to look at this data than most people look at it. And I think it's really important. So moving down, the dividends. This is a weird company for dividends. They don't increase it every year. It's kind of lumpy. They increase it from time to time. But when they do increase it, it's usually a pretty big increase. And so in 2018, they're going to pay out $1.40 per share. And back in 2013, they paid $1.16. So in 1, 2, 3, 4, 5, in about 5 years, they raised the dividend by 21%. During that period, actually, I think they only raised the dividend 2 times. But by raising it 2 times and raising it aggressively those 2 times, it's up 21%. And that's fine. It's not a hyper rate of dividend growth, but it's slow, steady, and it works. And the reason I actually like this is some companies I own in my portfolio will have higher payout ratios than others. What is the payout ratio? It's the dividends per share divided by the earnings per share. It's how much of the earnings are they paying out as dividends. And there are pros and cons of payout ratios, having a higher or lower payout ratio. I personally like to diversify my portfolio, so I have companies that have all different types of payout ratios, ones that have it high, ones that have it low. I like Campbell Soup, and it plays a role in my portfolio because it's one of those companies that's historically been very conservative on the payout ratio. They like to keep it low, which is great because it gives an investor like me confidence, and it gives them room to expand it in the future, even if the company doesn't grow at all. And so the payout ratio estimated for 2018 is 49%. They're paying out just less than half of their earnings as dividends. This is a lower, for a company like this, well-established, probably don't need to innovate that much, do need to digest that Snyder's acquisition. There's probably going to be a lot of money and time in paying that all off. That's a factor. And certainly this company has a history of acquisitions. They've acquired companies over time, and that costs money. And so that's probably where they need to save their money for. But in terms of innovation, sure, there's innovation in food, but it's not the same as tech. It's not the same as pharmaceuticals with research and development where one has to have heavy innovation just to stay current. This is the kind of company that makes great products, and without any innovation, they still taste really good. And so having such a conservative payout ratio for this type of company, it's something I like. It gives me comfort, and it shows me that there's room for growth. And they've historically kept it low. It's kind of bounced around, but 49%, 2017, 48, 2016, it was kind of higher, 69%, but 2016 is probably just a wacky year in terms of earnings. There's probably some kind of one-time event in there that I did not take the time to research for this video. But historically, looking back even to 2006, it was 39%. So they've kept it lower. Okay. Here's where things get really interesting, and why am I buying this thing? Why do I feel compelled to buy it now? It comes down to two reasons. It comes down to two fundamental reasons: the PE ratio and the starting yield. So PE ratio, how do we compute that? We take the current share price, which is $34.37, and we divide by this earnings per share. It's going to be, basically I took the low end of the range, 285. Let's just say it's going to be 285 this year. It's not going to be 290, it's going to be 285. PE is 12. They're trading at 12 times earnings. Typically, for a world-class name, a world-class brand like Campbell's, to be trading at a PE of 12, that's just bargain basement price. I think it's a price that would warrant no growth in earnings. And so I believe it's currently priced as if this company will never grow earnings again. And that's why I'm buying it here. That's why I like it. And I'm comfortable. I'm comfortable buying this stock at a PE of 12 if its earnings per share is 285 20 years from now. PE of 12, it's just a bargain basement PE, and it's a defensible company. The company's not going anywhere, in my humble opinion. The company has a very, very broad array of brands and products that we'll get to in a minute, foods, and it's just not going anywhere. And so having a PE like that is really, really attractive. And in fact, I think they will grow, so that PE of 12, it's going to go down over time as earnings grow. Now, where it also gets interesting is yield on cost. Right now, they're paying 35 cents per quarter, so I just take that, I multiply it by 4, and I divide by the current share price, which is $34.37. The starting yield, the yield on cost for someone that buys right now in 2018, it's 4.07%. This is an attractive yield for Campbell Soup. Why? They've never been a high yielder because they keep the payout ratio low. They like having a low payout ratio, and I like that they have a low payout ratio because they are conservative. It is a conservative company. And being a conservative company with a conservative payout ratio, having a 4% starting yield in 2018 on a world-class brand, it does not get much better than that. Yes, there's companies out there like General Mills that I also own that I love that are slightly higher. I think that one's at a 4.4. But that being said, Campbell Soup, 4%, I love it. It's a great starting yield. And so again, to me, this is kind of reminiscent of buying oil a few years ago when everyone hated oil. Right now, everyone hates this stock. It has a high starting yield, a low PE, pricing in as if this company will never grow again. And I'm just all over it. I can't get enough of this. And I actually think it'll go down more, and I will continue to enjoy buying opportunities on this stock and other stocks in the space. So what else? If there's a downside with this company, this is it. The market cap right now is $10 billion, 10.33. This is a small company. It's amazing how small given the array of brands they have. But the problem with this is it reminds me somewhat of Heinz. This, and if you know, you've been watching my channel, you know that I used to own Heinz. It was acquired by 3G Capital and Warren Buffett. It was taken private. I think they underpaid for it. I think the shareholders were left a lot of money on the table, but we had nothing we could do. Anyways, I don't like buyouts. When I buy a company, I like to hold it forever and ever. The problem with smaller companies like this is they are buyout targets. In a company like Campbell's, with the Campbell's brand, it is a buyout target. And I would not be surprised at these levels if Warren Buffett, 3G Capital, they are looking again to buy this thing out and merge it, maybe merge it with Kraft Heinz. So that's a concern of mine. That being said, it's a risk I'm willing to take because my portfolio, I have 37 positions, by the way. I can't just all hold really big companies, all 100 billion plus companies. I have to diversify by market cap. This is one of the smaller companies I own, one of the small caps, or I mean, it's not really small cap at 10 billion, but maybe smaller of a mid cap company. It's one of the smaller companies I own. I need those. I need those in the portfolio for diversification. And so I run the risk that someone comes along and buys this thing and underpays for it. That being said, I'm willing to consciously take that risk, but it's something I'm very, very mindful of this company. And quite frankly, General Mills, I think their market cap is just above 20 billion or so, something like that. And they're a takeout target as well. But this is more of a takeout target because it's just at 10 billion. That's just not a very lofty market cap. So let's move on a little bit more here. What kind of brands do they have? When people think Campbell Soup, they think, okay, they make the soup. that is just a drop in the bucket in terms of the portfolio of brands that they have. Did you know these guys own the goldfish? How many of you out there do you eat goldfish? I love goldfish. I try not to eat too many of them, but once in a while I treat myself. I enjoy the goldfish. I generally, it's one of my favorite kind of crackers / chips type foods out there. And goldfish obviously is a subsidiary of Pepperidge Farm. Pepperidge Farm obviously makes those world-class Milano cookies and a whole vast array of cookies. So they own those brands. They own the Campbell's brands. As just mentioned, they have acquired Snyder's Lance, which makes all kinds of snack foods. It gets them into that faster growing snack food sector, which I think is going to boost EPS quite a bit when one looks 5, 10, 15 years out. What else do they own? They bought a company called Bolthouse Farms Organic, a company that makes organic foods. Now, one of the reasons actually EPS is challenged this year is they went on a buying spree and they bought all these health kind of foods, organic foods over the last few years. Well, the raw cost of producing those organic foods, it's skyrocketing right now due to a lot of things. And it's actually putting some tailwinds on their EPS. That being said, I think the strategic move was right. I think if they take a short-term hit and margins shrink because they got into organic foods, they got into healthy foods, so be it. That is the trend. That's where things are going, and I like that they have that as part of their portfolio. And so, anyways, this is just a drop in the bucket. All of these things actually. Look at their annual report for 2017. They have a picture there of all the brands that they have. I didn't even know that they had some of these brands. In fact, I am a father of 2, and if you have kids, you probably know that these pouches, these pouches with the twist top, they usually have like vegetables or fruit in them. They're very popular with young toddlers. And one of the brands is called Plum, Plum. We love those in this household. Those Plum pouches, they're very helpful, especially when you're traveling. Maybe you're on a car trip, you're out on a family trip for the weekend or even for the day. Those come in very, very handy for parents, and they're really a lifesaver, honestly, for parents when a child gets hungry and you want just a really quick solution and something that's reasonably healthy. It's either fruit or vegetables. These guys own Plum. I didn't know that. I was looking at the annual report. I was like, wow, I like this company even more because I love Campbell Soup. I love the Goldfish, and I love the Plum brand. These are all brands that are near and dear to my heart. And in fact, Campbell Soup, I love the ones that come in that little cup where you can just take the top off, put that kind of plastic thing on top and heat it up in the microwave. I love that. And so anyways, these are all brands that I can get behind and I enjoy. Again, not going to be a core position in my portfolio, but I'm surely, as you can probably tell from today's video, enthusiastic and excited about this 12% drop. It's just fabulous. So fun video today. Really excited to share something in real time here. I'd be curious, what do you think about Campbell's Soup? What do you think about consumer non-cyclical companies? Do you like them? Do you dislike them? Are you as excited as I am in 2018? I know it's kind of contrarian. Most people do not get excited when their portfolio is down. And look, one other nugget of information here. It is very likely this year that my portfolio is going to, not only likely, it's going to happen with high certainty, my portfolio is going to drastically underperform the S&P 500. And that is because I have a lot of dividend stocks, I have a lot of stocks that are consumer non-cyclical, and they're just out of favor. Everyone hates them. Do I really care about outperforming the S&P 500 this year? Or next year or the year after that? I just don't. It doesn't matter to me because I cannot pay the bills without performing the S&P 500. But what I can pay the bills with are dividends, cash flow that is paid to me from these companies in good economies and bad economies, and I can use those dividend checks to pay the bills to eventually live off of. And so for me, it's a real long game. It's a game about generating cash flow. And so it's nice to beat the S&P 500. In the past, I have done that, and I've tended to do that on some of the big positions in my portfolio. They've done well and oftentimes have beaten the S&P 500. That said, that some of those winning streaks that I've had in the past, maybe they're over for a while. I am okay with that. I've come to terms with that. In fact, I would prefer that because it means that I am going to get higher starting yields and it will allow me to reach financial freedom quicker. Because I'd rather buy this thing at a 4% yield than a 3% yield. 4% yield gets me to financial freedom quicker. It gets me more cash flow from day one. So that's how I look at it, but I definitely have to put my ego aside, my portfolio value aside, because it's going down and it's a challenging year if one just looks at one's portfolio value, if they're a similar investor to me. And if one just looks at share prices, it's challenging. But for me, I don't even look at that very closely. Surely I track it, but what I really look at closely is my dividend stream. How much cash flow am I receiving on a month-to-month basis? That's what matters because that's what I can pay the bills with. Anyways, thank you for watching. Really, really appreciate it. I appreciate all the support. I'm getting so many good questions here. If you have questions, please put them in the description or in the comments below. If you like Campbell Soup, you don't like it, put it in the comments below. Let's start a discussion on this one. It'll be really fun. And I am responding to all the comments, although I'm about 5 days backlog now. So I'm just now answering questions and comments that were placed 5 days ago. So hang in there. I'm playing catch up. I really do appreciate your patience. And before I leave today, a disclosure. In terms of full disclosure, I own the companies that were mentioned in today's video. In particular, I personally own BP, ticker symbol BP, Campbell Soup, ticker symbol CPB, and also General Mills, ticker symbol GIS. I will link in the description below to the videos that I have about BP and General Mills in case you want to check those out. And in terms of a disclaimer, this is not investment advice. I'm not a licensed investment advisor. Today's video is just for your fun and entertainment. If you're going to go out and invest in the stock market or anywhere else, please consult a licensed financial advisor first. Thank you for watching. If you liked the video, please subscribe, give me a thumbs up, a like, a comment. All of that means the world to me. It helps this channel grow, and it is the greatest way you can motivate me to produce more videos here on YouTube. Thanks again. I will see you in the next video.